would you say that every new investor coming out should start with passive investments by any chance?
Yeah, I think it makes sense. I think for a newer investor, I think it takes some time for new investors to really find their way into which funds they should buy or which funds they should build their portfolio. So I do believe that index funds, ETFs, passive funds make life very easy for a new investor because you're getting a ready-made diversified portfolio of so many stocks. For example, if you buy a Nifty 500 index fund, you're betting on the Indian economy. You're basically betting on the top 500 companies in India. And by that definition, you're not really relying on one or two companies to do well or fail. You're basically generally sort of expecting the Indian market to do well over the long run. So you're getting a lot of diversification, you're getting low cost, and you're getting a fund which will always sort of I think over the long run do well in terms of performance. So I do think that yes, for a beginner investor, it makes life very simple. I think they don't have to do a lot of research. I think one of the main tenets of investing is not, at least from our perspective, is to not, honestly, people spend too much time and effort in trying to figure out the right investment. But the secret sauce is to invest early. You want to give compounding as much time as possible. So I think the earlier you enter, the better your wealth creation will be in the long term. And I think passive funds make it easy to enter early for new investors.
One thing also that people try to time the market, which apparently nobody can. And passive, when you do in a systematic way, probably could help us overcome that problem as well.
Yeah, absolutely. I think the biggest pitfall, I think one of the biggest reasons why most investors destroy wealth is that they're trying to make a quick buck by timing the market. They want to say that tomorrow the market's going to fall or day after the market's going to go up. But unfortunately, my sort of 10, 15, 20 years experience and having read hundreds of books, I've realized that timing the market is very, very difficult, almost impossible. It requires a huge element of luck, So I do believe that for investors who want to time the market, yes, they can do it. But I think overall, you should expect to make the same returns as what the market makes. And that's why I think index funds, you don't really have to time the market because automatically if you have an index fund in your portfolio, the largest stock, if it does well, your allocation goes up. If the smaller stock goes badly, it gets thrown out of the index fund. So I do believe that it's a very democratic way of money management.
Makes sense.
And I spoke about this earlier. Is that what you're investing in an index fund, say a Nifty 50 index fund, is not 50 stocks. You're investing in the top 50 stocks of India. And the top 50 stocks in India, I don't know the future of the 50 stocks I hold today in my portfolio, but I always know that the top 50 stocks in India will be bigger 20 years from now than they are today.
Definitely.
Which is why it's a great strategy for long-term investing.
Makes sense.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.